Hello, this is Placeholder here, and we're going to be talking about debits and credits today, the most basic of accounting. Now, obviously, when you're doing a journal entry, debits go on the left, credits go on the right. That's, the most basic part of it. If you don't know that, then you don't know anything about accounting. Now, you probably have a few questions like, why are debits on the left, why are credits on the right? Debits comes from a word debere, I believe, which means left in Italian. Credits has its own word, which means right in Italian. And this accounting system came from Italian monks trying to keep track of their barrels of wine. May sound silly, but that's actually how it came to be. And that's also where we get the abbreviations: DR for debits and CR for credits. A lot of people are confused by that in the beginning, and even when you ask most accounting teachers, they don't have a good answer as to why that is. So, yes, that's something that you all now know now and get out of the way. So now we'll talk about debit accounts and credit accounts. Now, assets, expenses, and dividends, they are all examples of debit accounts. They all go up in value when you put in when the debits increase. Credits obviously will reduce them. So let's go over what these all are. Now, assets, they are essentially things that have a future benefit to your company. That's pretty much what they are. Now, an example of them is cash. Now, we all have cash. That doesn't just mean like the money you have in your pocket or whatever. Money you have in the bank that you can spend. That's cash. Accounts receivable is also an asset. That's when someone owes you money. So those are the two biggest assets. Things like office supplies are also an asset, but just for them now, keep cash and accounts receivable in mind. Those come up the absolute most in any accounting class, more than office supplies. That stuff's usually there for a chapter or two, then it just starts to fade away. So don't pay too much attention to that stuff, just focus on cash and accounts receivable. Now the next debit account is expenses. An expense account is exactly what it is. It's an expense, such as rent. That's one that most people will have to deal with at some point in their life, whether it's an apartment or in the case of businesses, office space. There's also, there are obviously plenty of types of expenses, like office supplies expense and stuff. We all have expenses, so you all should know about this stuff. And dividends. Dividends is essentially, you taking money out of the company or whatever. That's what it is. And I really don't have much to say about it. Because I'm not really too familiar with dividends. They do come up occasionally in accounting, but usually it's much later on. So you're not going to have to deal with it early on in any accounting class. They'll mention it, but it won't be a priority. Now, we'll talk about the credit accounts: liabilities, equity, and revenue. Now, liabilities. That's essentially when you owe money, like accounts payable. The opposite of accounts receivable. You bought something on credit or whatever, you owe somebody money. Essentially, a liability is something you're on the hook for. Honestly, when it comes to liabilities, I'm not the greatest expert. Even now, I kind of get confused or whatever, but most important thing, the biggest liability you'll come across in accounting is accounts payable. That will come up the most often as an opposite to accounts receivable. So you gotta keep that in mind, and you should also just remember that liabilities aren't always bad. Because they do help increase your assets. yeah, I'll talk about all that in a later video, but the equation for assets is, assets equals liabilities plus equity. So they do have some value to them, which will be discussed later. Now, equity is stuff like common stock and retained earnings. Now, common stock is basic stocks. You just you buy it from a company. There's no special process or anything, and yeah, you can buy them and sell them. Credit makes it go up, debit makes it go down. Obviously, pretty simple. This is all basic stuff. And revenues is the final, credit account. And well, that revenue is revenue. It's pretty much profit. Now, a lot of people have this belief that credits are bad, so they're confused as to why revenues are a credit account. Truthfully, I don't really know why, but just get this in your head. Credits are not bad. Credits are good and useful. Having a line of credit can help your business grow. It can help do a lot of things when you're short on cash. Credit does help you gather assets by buying stuff on credit. Now, obviously, you have to pay it back, but it's a good way to get started off and accumulate assets, especially if you're short on cash and you have a lot of accounts receivable, but they're not getting paid right away. So all that goes towards building assets and hopefully building your company, whatever you're trying to build. Now, I think that's all we need to talk about for debits and credits right now. I'm not sure if I missed anything. If I did, please let me know down below. This is my first video on this topic, so I probably missed something. So, and obviously, if you have any other kind of questions, ask them below, and I will either answer them in the comments or in a future video. So